Silver is entering the most critical phase of its modern financial history. Not next year, not next quarter. Right now. What we're seeing inside Comex is not normal. It's not seasonal. It's not routine. Something structural is shifting. Something dangerous. December positions are collapsing. March positions are exploding. And the rollover happening right now reveals where the pressure is silently building. This is Smart Wealth Code, your compounding machine. Let's begin. Section 1. The data they don't talk about. On November 3rd, December silver futures held over 100,000 contracts. By November 21st, that number fell to 43,000. That is a 60% collapse in just over 2 weeks. But here's the critical point. These contracts did not go into deliveries. They did not close out. Almost every one of them rolled straight into March 2026. March open interest surged from 34,000, 84,000 contracts, an unprecedented early rollover, something we have not seen in many years. Large traders, the only ones capable of taking delivery, do not want December. They are pushing all the pressure into March, and that tells us one thing. March 2026 is becoming the most important silver month in decades. Section 2. The delivery myth. Most people don't understand who can even take delivery on Comex. The truth, almost nobody. Only a tiny minority has the infrastructure to receive physical metal. Industrial users, refineries, bullion banks, authorized participants, commercial hedgers, large OTC traders. More than 95% of Comex participants, hedge funds, CTAs, retail speculators cannot take delivery at all. They don't have warehouse accounts. They cannot take custody, so they'll always roll or close. And that is the key. A delivery request of even 3 to 5% stresses the entire system. Section 3. Why December won't be the crisis. Some assume December will trigger the squeeze. It won't. December is year end. Banks are closing books, hedge funds exit positions, refineries reduce activity, liquidity dries up. Nobody wants a December delivery obligation on their annual balance sheet. So the market does what it always does. It pushes the problem forward. That is exactly why December open interest is collapsing and March is exploding. March, not December, is a real battleground. Section 4. The registered silver illusion. Now comes the biggest misunderstanding in the entire silver market. Registered silver is not deliverable silver. According to the latest CME report, registered 152 million ounces, eligible 300 million ounces. But those numbers are deceptive. Registered silver includes metal under lease, metal pledged as collateral metal tied to OTC obligations, metal sitting in bank programs, metal reclassified for accounting optics. Eligible bars belong to customers. Comex cannot touch them. So how much metal can actually leave the vault if longs stand for delivery? Not 152 million ounces. The true deliverable float based on real historical movement, vault throughput, and past stress events is only, wait for it, 10 to 20 million ounces. That is the real practical capacity of the Comex vault network. Section 5. The global tightening. In 2025, Comex handled nearly 300 million ounces of deliveries, but only by draining every external source available. SLV ETF liquidations, LBMA emergency shipments via EFPs, China exporting silver India showing no premiums, eligible bars reclassified as registered. Those rescue channels no longer exist. Today, going into 2026, China is restricting exports, India is showing delays in premiums, LBMA inventories keep draining. ETF inventories are exhausted. Industrial demand is hitting all-time highs. The world is tightening, right as Comex faces its largest March concentration in modern history. Section 6. The March geometry. If March open interest hits 100,000 contracts, which current rollover trends strongly suggest, that represents 500 million ounces of paper silver. Now compare that to reality. Paper OI in March, 500 million ounces. Registered metal, 152 million ounces. Real deliverable float, 10 to 20 million ounces. Now, the critical scenario, if just 5% of longs stand for delivery, Comex needs 25 million ounces, but Comex can deliver at best 15 million. That creates a 10 million ounce shortfall, which triggers cash settlements, shorts forced to buy, spot massive backwardation. A violent repricing of silver. Even 3% standing, around 15 million ounces, pushes Comex to its mechanical limit. At 5%, the system breaks, not a formal default, but a forced repricing as paper loses control of physical. Section 7. The probability map. For the first time in modern silver history, three forces are converging into a single month: global physical tightness, paper leverage, policy constraints. Here is the probability map. Base case: normal tightness repricing, $60 to $80. Stress case: short scramble for metal, $100 to $150. Squeeze case: paper breaks, physical takes control, $400 plus delivery failure. Case: forced cash settlement, system reset, $600 plus, aligning with the 50-year cup and handle target. This is not a prediction. This is mathematics colliding with history. Whether the repricing comes quietly or violently, we will cover every step. This is Smart Wealth Code, your compound